you very much. So I'm James Goldstone.
I'm Ciaran, Mallon.
And we've got a lot to get through, and what was 20 minutes is now about 18 minutes. So we're just to tell you what we're going to talk about. We're going to begin by setting the scene and talk about a couple of important elements of the structural elements of the trust, and also the dividend policy that the board has set. We're then going to tell you how Ciaran and I invest, what we look for, why we look for it. We're going to show you how the portfolio is invested, and we're going to explain why we think the UK stock market looks attractive and why we expect our approach to deliver over time. So first, the structure, and this is the right slide, thank you. Select Trust is actually slightly unusual in terms of its structure. It's got total AUM of about £250 million, but that's split across 4 different share classes, each with different objectives, and you can see those in that light blue box on the left-hand side. And the structure confers the ability to switch once a quarter between the share classes without triggering a disposal for capital gains tax purposes, which, depending on where the shares are held, could be advantageous, and we think that's a key differentiator. It's quite unusual. Now, Ciaran and I run just the UK equity share portfolio. The NAV of that portfolio is about £160 million, and it's that and only that we're going to talk to you about today.
The second bit of important scene setting is around income. So the UK share class that we're going to talk to you about, it's in the income sector. It pays a quarterly dividend, and the trailing yield on the shares is 3.4% today. As well as the 4 share classes that James described, another unusual feature of Select is that the board can supplement dividends from capital. And for the UK share class, the board has chosen to do that to varying degrees since 2016. That's provided consistency of dividends to shareholders, so it can be reassuring in periods when dividends in the portfolio have been cut, and as we know in the market generally last year, there were widespread dividend cuts. Nevertheless, the dividend last year grew. This topping up from capital has another advantage for us. It allows us to manage the portfolio in a more flexible manner with an eye to the total return, and to try to generate returns for our investors from capital and from income as well.
Next slide, please. So the objective of the trust, and what Ciaran has just described about the board's approach to dividends, that's enabled us to construct a portfolio that's more balanced. So as you look at this slide, we have holdings that would appear on the left-hand side, companies like BAT, like Vodafone, that pay significant dividends today. But we also have holdings in companies that would appear on the right-hand slide, at the right-hand side of the slide, companies like Bunzl and Kroger, which are reinvesting to deliver meaningful growth in both capital and dividends in the future. So it's a balanced portfolio of companies with different attributes, and a portfolio that can deliver both income today and capital and income growth in the future.
And next slide, please. Thank you. So that flexibility that we've made reference to is we think is important, and it's allowed us in making the portfolio to focus on what we think is most important in putting the portfolio together. And we've worked out over time, managing money, what we think makes a good company, what makes a good investment, and what makes a good portfolio. And that's what we've put together for the trust. It's relatively concentrated. It's our very best ideas, and we hope it's capable of delivering returns whatever the weather. Now, by a good company and a good investment, we mean companies that make good returns on shareholders' money, with a credible management team that we can trust to allocate shareholders' capital appropriately. And we mean companies with the right balance sheet and whose shares are attractively valued. And by attractively valued shares, well, we try to relate what it is you're purchasing with what it is the company is, and it's the same kind of reasoning goes behind when you buy a house or buy a leaf blower or whatever. It's about relating the qualities of what you're buying with what you have to pay for it, and that's what we spend our time focusing on. And it's as much an art as a science, but it's about trying to find those opportunities where there is likely to be good returns for investors. And on the next slide, we show a picture of how the dividend looks in the portfolio. So the forecast for the next 12 months, as shown on the slide, is about 3.3%. Now that's before the impact of gearing, and we'll tell you in a moment what that is, and also before the board uses its any flexibility it may choose to use to top up with capital. And as shown on here as well, that dividend in the portfolio is well diversified and also well covered by earnings of the constituents.
So if we get to the next slide, we found that when we present to investors, people like to understand what the exposures in the portfolio are. And although Ciaran and I are very much bottom-up investors, and therefore this is entirely an output, we have cut the portfolio into 5 thematic groups. And so going from left to right, you'll see we've got just over a quarter of the portfolio exposed to UK domestic companies. We've got a similar amount exposed to international value. I think that speaks for itself. Businesses that are predominantly outside the UK, but where we see very modest valuation. We've got a similar amount, again, exposed to international growth companies, where potentially the valuation is slightly higher, but we've chosen them because they justify that valuation with a very strong growth track record and very strong growth outlook. We've got currently 7% in our recovery, what we've shown here is a recovery group. Now, all of those names are in that group today because they're recovering from the impact of the pandemic, and you'll see, if you know anything about those companies, they're all operating in an area of the economy that was very severely impacted by the pandemic, but as we come out of it, are recovering very nicely. We still see further recovery to come. And then finally, what we've called transformers. And when we say transformers, we're really talking about companies that the market thinks of in a certain way, but we think we've identified an aspect of what the company does or a new activity that is not yet currently recognised by the market and therefore not reflected in the valuation. And it's our anticipation that when the market does begin to factor that new activity in, that there'll be a positive impact on the share price and on the valuation of the shares.
And we thought it'd be useful just to give a thumbnail sketch of something from each category. So if we start with National Grid, which is in UK domestic, actually half the business is in the UK and half of the business is in the US. It's predominantly electricity transmission and distribution networks, with some gas as well in the US and some in the UK. And regulated utility, if you look back over the history of the business, it's done a very good job for shareholders, actually, a combination of income, growing dividend and capital growth, and with its own very particular risk characteristics, so very good sort of diversifying the portfolio as well. But what's exciting, I think, about it now is that they are pivoting the business towards more electricity. And the pithy way to express that is the UK, if it wants to get to its carbon reduction targets, is going to need twice as much grid, because we know that heating houses and we know that transport is electrifying, and that will mean a lot of investment needed in the national grid. And here's another pithy thought, is that an electric car outside a house is like an extra house. That's how much power they need. So all of that means investment opportunities for National Grid and growth, which I think is very exciting.
Now, in the international value box, Hiscox is an international insurer and reinsurer. It's got a very long track record of organic investment to grow into adjacent areas. It began as a Lloyd's vehicle, just operating in the commercial markets at Lloyd's. Many years ago, it began to invest in a retail brand, and if you've caught a train somewhere in the home counties in the last decade, you've probably seen a Hiscox billboard at some point. That's absolutely a scale business, been very, very successful organic project. And about 10 years ago, Hiscox decided to start to invest in a commercial insurance business in the US for small and medium-sized enterprises. They spent about $500 million over that period. So it's been a heavy investment. The business today has about $400 million of premium. But Hiscox have made the choice, rather than to earn a profit from this new venture, to continually invest the proceeds into further growing the brand. And the current rate of growth is about 25% annually. And because it's not currently generating a profit, when you look at the Hiscox P&L, there's nothing in the P&L, in the profit line, for what we think is the most exciting part of the group. And therefore, when people apply a multiple of earnings and compare Hiscox to its peers, implicitly, given that the rating of the shares is broadly in line with the peer group, there's nothing in the price for, as I say, what we think is potentially the most exciting aspect of the investment case. And so we think that's a genuine value situation, and we think it's something that over time, as this business continues to grow, and there's a long runway of growth for it, that can be reflected in the share price, and you know, we're very excited about it.
And if we look at international growth, now the UK market is blessed with some world-leading businesses, and one I wanted to mention was Croda. It's a chemical business. The heritage of that, and still the heart of that company, is the chemistry of fats and oils and products derived therefrom. And that's not oil out of the ground, that's oil from renewable sources. And so that's one great thing about it. Its ESG credentials are wonderful because it's largely renewable inputs into its products. Huge range of different kinds of chemicals are derived from those inputs that are used in a huge range of end markets. Essentially, they help their customers do two things. One is either enhancing the product that it goes into. So that might be, they, for example, produce seed coatings which allow seeds to germinate more reliably. Or it might be something which a customer uses which makes the real performance promise that goes on a product. And so amongst the many things they do, they might do an active ingredient which helps protect skin from UV radiation that can go into a skin cream. Very exciting at the moment, however, is the part of the business in healthcare where the COVID vaccines based on mRNA needs some means to protect the strand of mRNA while it gets into your body and gets to where it needs to go in your body. And the way that's achieved is a little ball of fat around it. And that little ball of fat, in the case of Pfizer's COVID vaccine, some of the ingredients for that come from Croda. So that's a perfect example of the kind of thing that Croda does, that's of huge value to the end product, and is obviously currently is a very exciting area of growth for them.
So just with an eye on the clock, I'll probably accelerate a bit. In the recovery box, we've got Dfs Furniture. It's the biggest sofa retailer in the UK, about just over a third of the UK sofa market, both from showrooms, which you've probably all seen on retail parks, but also online. The great thing about sofas is that almost everybody that buys one wants to sit on one. So this is an area of retail where that physical presence has real value. And the fact that Dfs is so big, 35% nearly market share, and with that scale, have a completely different margin structure to what is a very fragmented and weak competitor set, is really now being brought to bear. And so the prospect for further market share growth, as more and more of those competitors struggle to compete with DFS, whether it's in manufacturing, whether it's in what DFS can afford to pay for a click online, whether it's in the negotiations with the tenants. It's got genuine advantages which we think are embedded, and it's now beginning to grow in adjacencies like bedroom furniture. So there has been a recovery since the pandemic, but we think there's a lot further to go, and the valuation looks very, very modest.
And then finally, and I'll also speed up, next was the transformer that we wanted to talk about. We know that the retailer Next, and it's a fantastic track record, great margin, great balance sheet, fantastic management track record. It's a very tricky sector to do well. They've shown that they can do well. But what's very interesting at the moment is they've won and proven to be a great business online, and they're taking all of that capability they've got, which is everything from warehousing to websites to fulfillment, and they're offering that to third parties. And that's a fantastic growth opportunity for them for the future, we think, and it's unrecognised, we believe, in the view of the market generally at the moment of Next shares. Next slide, please. And so this is the performance. So we've shown you, how the trust is structured, how we think about investing, how the portfolio is positioned today, but how has it worked? Well, both the recent and the long-term performance, which is the top two lines on the chart of the share price and the net asset value, both short-term and long-term has been very strong in performance, outperforming the FTSE All Share by some margin. So it's a good track record there, I think. We appreciate, however, that the UK stock market faces a lot of competition from other places in which you can invest. And so we thought we'd finish off by trying to persuade you that despite rumours to the contrary, the UK stock market is not dead.
So if we just look quickly at the next slide, I think there's a perception that the reason that the UK stock market has underperformed the US is all down to the technology sector, where we're all users of these mega tech platforms, and they're all quoted in the US and they just don't exist in the UK, and that has certainly been a factor. But actually, it's not the only explanation. And if you look here, we thought, given it was December, we might give you a bit of a Christmas quiz. We've anonymized 4 companies that we hold in the portfolio. The companies that we hold are all the dark blue lines. So top left-hand side, international telecommunications company listed in the UK. You might guess that one. Top right-hand side, the dark blue line is an international medical equipment company listed in the UK. Bottom left, it's an international electricity and gas distributor, which we may already have mentioned, is the dark blue. And in the bottom right is a bank, an international bank. And what you'll see is that ever since the Brexit referendum, which is where these charts start, each of those 4 very international businesses have materially underperformed their US peer group. And so we think it's about a lot more than the US tech sector. These are only 4 examples. There are many more. And in our experience, these sorts of situations do tend to resolve themselves in time, either via a re-rating or potentially via M&A. And obviously, we've seen a bit of M&A in the UK market in recent times.
And next slide, please. And a different way to look at valuation is to look at how markets are currently valued versus their past. This chart shows the current price to book ratio for various markets against the median of the past 20 years. And if it's below the light blue line, it means it's at median for the past 20 years. And the UK, of the ones we've shown here, which includes the world index, but also some major markets around the world, and the UK is below, and most other markets aren't. So, and that's been the case for quite a few years now, but the discount is beginning to narrow.
And then just finally, on the last slide, we thought we probably shouldn't go all the way through a presentation without giving you some thoughts about the current environment. I'd say that we are suitably cautious around the pandemic. I mean, I think as we discovered last night, there are still risks, not least with government response to the pandemic, which can have and can potentially have further impact on the economy and on the earnings of the companies that are in the UK market. So we're suitably cautious, but at the same time, we are hopeful that the world will at some stage learn to live with the virus, and therefore, the recovery that we've seen since the depths of March last year can be sustained. I think a second point I'll pick off this slide is just inflation. We've seen the highest levels of inflation in a generation as the economy has reopened, and we've been compounded by all the supply chain disruption. And that may not prove to be transitory, and typically that will be thought of as not great news in an absolute sense for equities. However, everything that we've tried to convey about the portfolio is that it's balanced, and we have a number of companies that we hold in the portfolios that would actually be significant beneficiaries from high and sustained inflation. So overall, I think we'll just finish off by saying, there's nothing in the current view that changes our confidence in the long-term prospects of the companies that we own. The portfolio is balanced. It can perform it's been designed to perform in a range of economic and market regimes. The track record for the trust is strong, and the structure and the board's approach to dividends are, we believe, real advantages.